Good morning and welcome to the Open here on BNN Bloomberg. I'm Roger Peterson. Thanks very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. There are numerous reports that Iran may be nearing a potential agreement with the U.S. to end their conflict with the U.S. Both sides are working toward a short one-page memorandum, with negotiations appearing to gain momentum after a pause in U.S. military activity. Now, officials expect a response from Iran on key issues within the next couple of days, though neither the White House nor the State Department has publicly confirmed the details. Loblaw's first quarter results came in slightly ahead of expectations, supported by steady performance across its grocery and pharmacy businesses. The retailer saw modest growth in both food and drugstore sales, helping lift overall revenue. The company is maintaining its outlook for the year and continues to expect solid earnings growth as it invests in store improvements and operations. Restaurant Brands International's same-store sales growth for the quarter came in slightly ahead of expectations, helped by continued strength at its Burger King chain. The company benefited from steady demand as fast food operators lean into value offerings to attract consumers facing higher living costs. The results follow a similar trend across the industry, with rivals also seeing gains tied to discount-driven traffic. And a quick look at the markets, and you can see the reaction to the news out of the Middle East, a deal between the U.S. and Iran to end their war. And the markets are all trending upward right now. NASDAQ by more than a point. It continues to be on a hot streak. S&P 500 as well, up by 0.68%. And looking at the TSX from yesterday, and for the year, you can see one year it's up, but yesterday it took a slight hit. Shopify dragging it down. Shopify was down significantly on its earnings report. And of course, the two things that everybody's paying attention to, oil and gold right now. Oil, let's see what it's doing. And WTI is off. It's at 95, although it was down below 90 earlier in overnight trading, but it's bounced back or slowed down a little bit, that downward trend. Still, though, off by 6.8% at 95.29 roughly. And gold, it's going the other way, or it was earlier. You can see, it's up about 3%, still off its highs, the record highs, but still up over the last year. It's at just cracking that $4,700 an ounce mark. And markets are poised to open sharply higher as a negotiated end to the Middle East war is reportedly within reach. Meanwhile, Canadian investors have a slew of earnings to look over, including Cenovus. My next guest says the energy giant is one of the biggest winners from the Iran Hormuz shock. Joining me now is Jim Thorne, Chief Market Strategist, Wellington Altus Private Wealth. Jim, thanks as always for joining us. Thanks for coming in.
Thanks for having me.
Can we just get initial thoughts on what's unfolding right now today? Or is it just another day in the Middle East?
There's going to be a deal.
You think so on this?
There will be a deal eventually, right?
Yeah.
And we're going to have a flush of oil come onto the market. I think the world has changed dramatically because of the closure of the Strait. I think this plays right into Canada's strength in terms of, do we want to become a resource superpower or a hard power? Mm-hmm. And I think Mr. Carney understands that. And so you've got some energy stocks that have really benefited. I mean, that are up, between 70 and 80% for the year. And what does the world look like if we go from $100 oil down to $60 oil? Doesn't mean that these companies are bad or their cash flow is bad. It's just that the sentiment might change. So, you might sit there and see a period of time of consolidations. But long term, if we take advantage of this situation that history has given us, Canada is looking really good going forward.
The big question is, two things. Can we? And has the world changed enough? Has this been closed long enough that people are now looking and saying, let's find an alternative?
Yes, I think it has. And I think, where I get everybody upset, because what I do is I sit there and I go, President Trump is pragmatic. And I don't listen to the noise. Yeah. And I also, when I go out west, I sit there and I go, Mark Carney's pragmatic. He's a pragmatist. He's not an ideologue. And when you listen to Mark Carney in his economic areas, he understands this, and he's got to slowly move Canada back to the center. And so we're in this period of time where things have changed. Energy and resource security is top of the list, and climate, even though it's important, has moved back down. So yes, it's very important to Canada. And the real question is going to be for us is how quickly do we want to move to basically grab this generational opportunity for us?
And what's it going to take, or what's it going to need? Is it going to be government spending or just government approval?
Well, I think
the green light from the government.
Right. So everybody lost it with the spring statement, right? And I think, what Carney knows is that, look, the global capital markets have had enough with us. Mm-hmm. And Carney also knows that we've got to evolve quickly. And so I think he's going to use debt to help do that. And so I think it's going to be a transitional phase where he does use debt. And listen, debt to increase the productivity of an economy is good. He understands that. Okay. And then we change the environment so that, foreign capital comes in. Remember, we had the Shell deal with ARC. And so, it's early days, but the problem is up here in Canada is we can't move as fast as the United States. So when I hear the Prime Minister say the risk is the United States, I interpret it completely differently. To me, it's Trump and the Americans are moving. Mm-hmm. And, we take the world as it is, not as we want it to be. We have to adjust rapidly. And when we do, the future looks bright for our economy.
All right, hopefully, and we have to keep up. And the reality is the Americans are next door to us. They're not going anywhere.
No, they're not going anywhere.
And we're still going to be dealing with them.
Yes, sir.
All right, let's talk about some stocks you want to look at. Synovus, what were you liking about it, or what?
It's just energy. Canada Energy. After a pullback, I think we're going to get a pullback here. Then the will we expand capacity? People understand our natural resources are saved. Can we get past, or can we be honest with ourselves in that the oil in Alberta relative to Venezuela and relative to Iraq is better for the environment? Can we shelve the carbon capture? We're starting to hear things. You're starting to hear about approval of pipelines to the United States. That's our short-term solution. You may not like it in terms of our economic sovereignty, but that's all we got. It's going to take 5 years for us to basically get ourselves together. So energy is going to be a key component of our industrial strategy. A little bit of a pullback here because we ran in, but investors have to use this pullback to position themselves, and Synovus fits right in there.
And okay, we've got a few, so I want to get to some. TransAlta, essentially.
It's a pipeline, but it's going through a generational change, right? So if you like turnaround plays, new CEO, it's fine, but it's lagging the space. I'd put it that way.
You put it that way. But can it catch up?
Sure. Yeah, but it's going to take time. But, in days where we've got like Flextronics up 27% pre-market and AMD, the fever's coming back. Right? So this is going to be about, as building portfolios, is going to be tactically adjusting your portfolio. And I think, 8,000 is my target, but we're going to have these rolling bull markets. And right now it's memory and hardware in the United States, and it's gone vertical, just like gold did a couple of months ago. It'll reach a level and then we'll trade sideways.
All right. And you mentioned gold. I am gold. People going to turn their attention back to gold now, do you think?
Yes, but the thing I like about it, but the difference is we've had our generational trade. So the five baggers off the table. Yeah. My view for gold between now and the end of the decade is it's 10,000. That's a double. The S&P is going to double. So think about this. Gold and silver are beta plays. I love them. Mm-hmm. I love them. But the big money's been made. And as this fever starts to kick in, everybody's going to be looking at, where's the next Flextronics, or where's the next Micron, or I Am Gold had a great run. It's a great company. Same thing with Pan American Silver, right? Fantastic. But you've got to change your perspective and to realize that now the big run's over and now they've got to execute. Mining is a very difficult business. But yeah, I still like to spend. I've been an advocate all the way along, having 10% of your portfolio in gold and silver. Yes. But I haven't changed, right? Yeah. I haven't changed. But as a portfolio manager, it's about rotating capital. We're going to be in this running bull market. So, how much dead money that's going to be consolidating do you want in your portfolio? That's the question every individual investor has to ask.
And what are you doing with how much dead money do you have?
I'm trying to get everybody. So for me, when the war started, it was sell gold, sell energy, rotate capital. I think tech is the place to be for now. Hardware over software, when we build out an AI platform, that's where we are. But, then you sit there, we've thrown the baby out with the bathwater with software. I really like that. Passing of the Clarity Act in the United States, you got to look at crypto. I love banks because we're going to, as oil comes down, interest rates are going to come down. And the big question is, when is Tiff Macklin and Jay Powell realizing that they're too tight and they have to cut more? And when they do, then the consumer kicks in and real estate kicks in.
Okay. On that note there, we're going to wrap it up. But thank you, as always, for joining us.
Thanks for having me.
All right. And that is Jim Thorne, Chief Market Strategist, Wellington Altus Private Wealth. Just ahead, we'll get back to the oil markets as Iran is reportedly evaluating a U.S. proposal to end the war. China is calling for peace as well. When we come back, we'll hear from oil analyst Stephen Short to hear what this could mean for the oil markets and record gas prices. Oil is down as stocks gain on hopes for an end to the war in Iran. Earlier, we got perspective on what this means for the oil markets with Stephen Short, principal and editor at the Short Group.
I suppose it's progress, but we really do have to take it into with a grain of salt. Keeping in mind that the futures market can reprice instantly. They can reprice as fast as a trader can hit the sell button on their keyboard. So to paraphrase Ronald Reagan, futures markets trade on trust. The physical market trades on verification. So yes, we do have this headline, but the physical market has to see more than just a social media post. So vessels that have been diverted away from the Persian Gulf are going to remain diverted. Refiners who are now buying because we're entering the peak season, buying crude oil, are going to continue to buy at high prices. So we are looking at higher prices longer, regardless of what we're seeing in the futures market now. So the point being here now is that, yes, this is potentially good news, but hey, we've been down this road before. We've seen these spikes both up and down in the future markets before, but what we're seeing in the physical market, what you're seeing in the spreads, whether it's Dubai Brent, Brent WTI, Brent versus Houston, the physical market has an extreme pull on the market, and prices are going to remain higher, certainly as we kick off the summer driving season.
Thank you for that dose of reality, Stephen. When it comes to the inventories globally, where are we? How tight is this market?
Yeah, it's really interesting. So it's not necessarily about barrels per se or supply. It's about logistics. So regardless of how much supply, and for instance, here in the United States, we are at multi-year highs when it comes to crude oil. And this is what's happening. The vessels are coming to, as the president in your clip before said, people are learning to buy U.S. oil. This is true. So what happens? Empty vessels are leaving lower inventory markets to come to the United States to load up, which leads unto a lag time of longer transit times, which will keep the market short of oil. So not necessarily because of the supply, but it's because of the vessel economics or the lack of vessels. And this is where the market has dodged a bullet up until this point. That is to say, this conflict began back in late February, early March, when demand for crude oil is at its weakest. Then we went through March, April, when refineries are in their turnaround season, their maintenance season. They are buying fewer barrels of oil, getting ready for the summer. Well, guess what? The summer is here, or it's about to be here. Refiners are coming out of their maintenance season. They have to buy these barrels, and therefore that is keeping the bid in the market. And that is most likely kind of the impetus of the White House to push this narrative that a peace deal is almost afoot because the hammer is about to hit the market. The demand, the one variable that's been missing from the market, has now returned, and it's going to return with a vengeance in the weeks ahead.
Also, it comes, as Jonathan has been saying, U.S. gasoline is above $4.50 a gallon, the highest we've seen since 2022. Could we get to $5 in the next few weeks?
Not likely. So what we've seen here, and the Federal Reserve has a study that's called Rockets and Feathers when it comes to retail gasoline prices. When we see a disruption in the flow of oil, prices at the pump will take off like a rocket. But then when we see some sort of resolution to whatever disruption it is, prices fall back to earth like a feather. So there will be a lag. Now, retail gasoline prices on average, where we're looking at the EIA or AAA, are about $4.55 on a national average. They're going to remain there for the next few weeks. Can we get to $5? At this point, I do think it is unlikely given where wholesale gasoline prices are trading in the United States. So if we are not at the peak of retail gasoline prices currently, we are going to near that price. We're going to near that level within the next few weeks. But that's not to say we're going to see a continued pullback, because keep in mind, in 3 weeks, 4 weeks, it's the Memorial Day holiday. So now prices will begin to remain high. So that feather aspect will remain high. Prospects of $5 gasoline, looking at 10 years worth of regression, is very limited proposal at this point.
Up next, we'll hear from the CEO of Novo Nordisk and find out how the company's new Wegovy pill fueled sales in the latest quarter. Novo Nordisk CEO Mike Doustar is discussing the drug maker's Wegovy obesity pill, which fueled sales in the first quarter. Novo is very optimistic on the medication, despite competition from Eli Lilly. Earlier, we got perspective from the CEO in a Bloomberg interview, and he says the firm doesn't anticipate any price reductions.
We are very excited about the pill, and of course, that's a result of also us today upgrading our previous projection. After 16 weeks of having launched this product in U.S., we see more than 1 million people having used it, or 2 million prescriptions have been written. This puts the Wegovy pill amongst the best launches in the pharma history. So we are very optimistic and excited, and this has happened, of course, despite the fact that for the last month we have seen competition having arrived.
So at what point would Wegovy pill prescriptions actually surpass Wegovy injection prescriptions?
That's a great question, actually. So one of the leading indicators to market share is usually the new-to-brand prescription, so it's a so-called NBRX. We have seen that right now, when you take all of the Novo Nordisk products versus our competitors, 65% of all the prescriptions are being written for Novo Nordisk GLP-1 products. So that is super exciting, of course, and we see the impact of the Wegovy pill positively influencing our Wegovy injectable. I also have to say we have recently launched Wegovy HD, or the so-called Wegovy high dose. That puts the weight loss magnitude of Wegovy injection on par with our competitor, knowing that we have a label for reduced cardiovascular events, reduced heart attack, reduced stroke. Tells me that patients are now able to understand the benefits of Wegovy just beyond weight loss, on par with our competitor, and hopefully the future will be bright.
And so, Mike, I mean, if we speak, and I hope to have many more interviews before then, but if I speak to you in 2 years, I mean, again, what's the difference between the pill and the injection?
Well, the efficacy of the taking a daily pill versus taking a Wegovy injections 2.4 is exactly the same. So with the pill taken daily, you basically lose some 16.6% of your body weight on average. That is incredibly above and beyond anything else right now in the market in the pill format. I have to remind you, Wegovy pill is the only peptide in a pill. The word peptide has become quite famous nowadays in the US. Well, this is a peptide pill, and because it's peptide, it's powerful. And patients are very much being attracted to it because of its power of weight loss. In addition, of course, when they see that this is a very tolerable product and it is Wegovy, so it sits on the back of millions of lives of safety data over years, then it makes it very powerful for quarters to come, I would say.
And Mike, would you rule out any future price cuts actually this year in your obesity portfolio, especially for the direct-to-consumer sales?
Well, I think we have priced the product right now exactly at where we wanted it to be. We have a starting price in the U.S. at $149 for the Wegovy pill starting dose, and we see this crazy uptake, I would say, that has been the result of many more patients being affording this product. So based on this, we have no intention right now to look into the price, but really continue via different channels, expanding our coverage and making sure that our products gets to the hands of everyone who needs it.
What's the most important gap you see that Novo needs to fill in its experimental medicines? I know in the past you talked about M&A. Is that still in the cards?
I think we basically are focusing on few areas: diabetes and obesity and all of its comorbidity. It means that we need to be able to compete with everyone who is interested in coming in this area. And there are many companies, of course, now that are excited to come, especially into the obesity field. To do that, we need to have the richest, the broadest, the best pipeline. We have a lot of that in-house, and I'm very excited that we are seeing an acceleration of our in-house pipeline progression. But I also have said that we continue to search outside for other innovations that are not invented in our own backyard, and the team is very busy doing that. So once we find molecules that are complementary to what we do, then we will not shy away about bringing them on board. And we have seen the best version of that with the so-called UBT251 molecule. This is a triple agonist molecule that is now entering phase moving into the clinical development further on, and it's probably the best in class, and that was an acquisition from a Chinese company. So we will continue, of course, showing the best of our BD approach as we go forward.
So are you looking for a startup or someone doing a special molecule, or is there another gap that you need to fill?
I think when you take a look at obesity and all of its comorbidities, that's where you're going to see Novo Nordisk focusing on. You're going to see Novo Nordisk focus on weight loss, the magnitude of the weight loss, quality of weight loss, how often you inject yourself, injections versus pill, but also into the areas like cardiovascular benefits, liver benefits, kidney benefits. Many of the areas where we have been involved in will be expanding over years to come.
The opening bells are coming up next. And time now for the opening bells at the NASDAQ. It's the Himab Therapeutics, and they're ringing the opening bell there at the New York Stock Exchange. Wheaton Precious Metals celebrating 20 years of being listed there. And on the TSX, the Toronto Tempo are ringing the bell to celebrate the expansion of the Women's National Basketball Association into Canada, recognizing a landmark moment for professional women's sports in Canada. Their first game is coming up shortly, very, very shortly, in a few days. Time now for the first 15. This is BNN Bloomberg. Trading is just getting underway, so let's check in on the equity markets and see how things are unfolding. You can see the reaction positive right now to everything that we are hearing from the Middle East. The possibility of a truce, a permanent truce between the U.S. and Iran is going to fuel the markets today. You can see the TSX bouncing back from that off day yesterday. It's up more than a point, 1.07 right now. S&P 500 up by 0.6. And the NASDAQ at about the same point. We're almost neck and neck right now around that 0.6 mark and rising, though. And one of the ones that dragged everything down yesterday, Shopify. Let's see how it's doing today. It was off nearly 16% yesterday on revenue concerns, and that it might drop even more, even though the first quarter results did beat most of the expectations, but still people not happy with it. And you can see it's bouncing back a little, but not much. Not making up that 16%. And it's been struggling for a little while now since the start of the year, essentially. It is off from that November high there. And so for now, we'll see what happens with it, but it's up about half a point right now and rising. For movers south of the border, we are now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team. Jeff, thanks as always for joining us.
My pleasure. Thank you for having me.
All right, let's talk NVIDIA. They inked does it sound better to say a $500 million deal or a $500 million deal?
You know what? I was thinking about this. This is almost a small number for NVIDIA, but
it's a big number does seem Corning. Like that. Okay.
That's right.
So one of them is very happy.
Yeah, Corning is very happy, and the shareholders are ecstatic. This is the top-performing stock in the S&P 500 so far this morning. It is up 18%, and that adds about $25 billion to the company's market capitalization. So what happened here? NVIDIA is inking a $500 million deal for shares in Corning. Corning makes fiber optic cables. And fiber optic cables, as you can imagine, are in a lot of demand for the build out of data centers and the overall AI infrastructure build out. So this is a stock that has been just on a tear in this kind of data center and AI driven market. The last time the shares were up to this extent was back in 1999, 2000. So this stock has enjoyed a very sharp run up. And now, as a result of NVIDIA's $500 million cash injection, they have changed their revenue expectations over the next several years. Now expects to reach $20 billion in annualized sales this year, rising all the way to $40 billion through 2030, or sorry, by the end of 2030. So yeah, big move higher today, big move higher in revenue expectations, big move in market cap. And the only one that might be a small move for NVIDIA, that's $500 million. Again, not such a big number for NVIDIA, but a very, very big number for Corning.
Somebody at NVIDIA is going, has anybody seen 500 million? I had it here a couple of minutes ago. What do we do with it? Now, is fiber, is the hopes that it'll replace a lot of copper? Is it competition for copper in this sector?
My understanding is that within the data center itself, moving that data, moving those bits and bytes around requires this fiber optic cable. And it's part of the bringing these data centers online this is extremely necessary. And so this is a company that also saw a lot of demand back in that .com kind of bubble stage when everybody, all of these communications companies were trying to build out their own infrastructure to connect every house to the internet. Now this data center demand is really, really driving up the demand for those fiber optic cables.
Okay, and AMD rallying after AI demand fueling a blockbuster forecast. How much of a blockbuster?
How much of a blockbuster? Well, this is the second best performing stock in the S&P 500. Stock is up 17% right now, and AMD is no small company. That's $111 billion in additional market capitalization that AMD has added so far this morning. So what happened? They reported results. Their results were better than expectations. The guidance is better than expectations. This company is largely considered kind of the leading challenger to NVIDIA. And now companies, investors are largely very, very positive on what they announced this morning. And analysts on Wall Street, some of which may have been neutral previously, are now kind of jumping off the sidelines. So, for example, Goldman Sachs upgraded the stock from buy to neutral this morning. Bernstein did the same thing with an upgrade to outperform from market perform. And they got a rash of price target upgrades, including at Goldman Sachs, Bernstein, JP Morgan, Truist Securities, Citi. So a wide number of Wall Street banks this morning kind of, I guess, catching up to the news here. All right. As I said, AMD second quarter revenue is going to be $11.2 billion. And that is well ahead of analyst predictions of $10.5 billion. So yeah, still a lot of froth, a lot of demand for chips. And as I said, AMD is kind of considered one of the leading competitors to NVIDIA and maybe potentially a challenger.
All right, we'll have to see if there's room for both. Jeff, thanks as always for joining us.
Thank you.
Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team. Coming up, we'll get a check-in on the markets and get some ideas for your portfolio with Sartorial Wealth's Shiraz Ahmed. Stay with us. It has been a challenging several months for investors trying to navigate volatile markets during the Iran conflict. Let's find out how one portfolio manager has been positioning in some stocks he's added to his portfolio. Joining me now is Shiraz Ahmed, CEO of Sartorial. Well, Shiraz, thank you as always for joining us and coming in and bringing some color too.
Thank you. My pleasure. You got to have some fun with
in
it.
Toronto, it's a rainy, cloudy kind of day, so some color is a nice thing. I guess we could describe the markets over the past month as colorful. They have, and some colorful words have probably been used at times by people.
Absolutely. I mean, this has been one of the more volatile markets that I've seen in my professional career, and it seems to be an outlier event happening every single day here and there. So it's definitely been one that we've been watching very closely, and it's never a dull moment.
And how have you been managing? What are you looking for? What trends are you looking for? Are there any trends with what's going on right now?
So in our practice, we're primarily momentum-based investment managers. So we look at momentum in the sense of risk-adjusted return, which is really kind of the primary way that we look at momentum. And so we're constantly rebalancing the portfolio to, the best way to describe it, it breathes with the market. So as we saw over the last little bit, the markets breathe towards a higher concern over geopolitical risk and energy and higher levels of volatility. So the risk on, risk off, it's constantly rebalancing. So that's kind of the way that we've been doing it over the last little bit.
Have you been busy?
Yes. To put it very lightly, it's been very busy.
So where is the rebreathing taken you?
So lately, it's taken us to a little bit of a higher weighting in energy than we have historically over the last little bit. So one of the first stocks that I kind of wanted to talk a little bit about was Marathon Petroleum. As one of the largest oil refineries in the United States, they are one that has frankly done extremely well as a result of the current geopolitical crisis and the current conflict that we're in right now. They've also increased their crack spreads a little bit as well. I'm by no means an energy analyst, but that being said, they are really well positioned, and there's a degree of insulation in there. They've done a recent $5 billion share buyback announcement as well. So I think that there's a lot of legs still left in this trade. And again, it's risk-adjusted return. So given what we've seen over the last little bit, the stock has actually performed quite well.
And does it feel like that trend is going to continue? If even what we're hearing today, that maybe there's settlement, there's a deal in the Middle East. I mean, they've been pumping out like crazy, haven't they?
They absolutely have. So this has been a phenomenal time for any energy producer. But as a refiner, so they're basically taking crude oil and making it into gasoline and diesel and other uses that we actually need as consumers. So they have a degree of insulation in their actual operations as well. So because they're a refiner and not necessarily one of the drillers, it's a different play. So that's part of the reason why we like it. And again, they have some momentum in there as well.
Okay. Going the other way, are there any things that you're staying away from, like with this momentum and with the way things are heading? Are things you're shying away from, sectors you're shying away?
I wouldn't necessarily say that we're shying away. So again, as part of the way that we invest is we try to not necessarily make the human emotional decisions when it comes to investing. So a lot of it is very algorithmically based. So we have a representation from a majority of the different sectors that are out there. Currently, I'm seeing that there's less of a focus on software in general. I think with the current AI trend that's happening in the background, we've seen them just unfortunately in the penalty box for a little bit as we still kind of sort out what the obvious winners and losers will end up being. So we've had a lower weighting in software, and frankly, I think there's little to none at the moment.
So no indications. It's the trend is downward still with that.
So far, and again, if the momentum starts to pick back up in them, again, we're happy to participate. So we take a very agnostic approach. These are all widgets. They're tools in a toolbox. So we'll jump in, we'll jump out. If we see that there's value, we'll happily jump in.
All right. When you're seeing values in Roche Holdings, a global healthcare leader?
Yeah, so they're a very diversified healthcare company where they have both the diagnostics and the pharma side of things. They're a nice dividend play as well. We don't necessarily invest for the dividend, but it's one that has had quite a sustainable dividend for quite some time. So of kind of the three positions I'm talking about today, I'd say this is probably the most defensive of the positions out there. They seem to be doing quite well, regardless of sort of the macro environment currently that we're seeing. And then I guess the last piece that I wanted to sort of talk a little bit about today was with really on if I were to say Roche has been a very consistent play, and it's one that we have been very, very happy to be a part of, and we've jumped in and out of it a couple times over the past year, but it's one that we're currently happy to have and is increasing our international exposure in Europe as well.
So it's been consistent, but you're still jumping in and out?
It's consistent in its dividend and sort of its defensive position, but from our standpoint, it has to have positive price momentum for us to participate in it. So this is where we've jumped back into it again recently.
And what are some of the things bringing it to the table to you, or bringing your attention to it that it looks like it's going to trend up?
It's primarily risk-adjusted return. So that's really kind of our main focus, and our primary data point that we're looking at is it behaving well right now or not. It's fairly binary in that sense. So we don't take a lot of opinions on the stock overall, but it has had a very strong fundamental backing in it over the last little bit, and so that has frankly been supported by the current price movement.
All right. Another one you're looking at, Tokyo Electron.
Yes.
Which sounds just as fun to say, first of all.
Absolutely, it is.
What does it do, and what are you doing with it?
So I would call them a picks and shovel semiconductor play. So they make a lot of the manufacturing equipment to create some of the semiconductor chips, like companies that NVIDIA and whatnot would actually use. So I would say that they're another infrastructure play on the ongoing AI theme. I don't think the AI theme is over. While it's not making as much headlines as it was, frankly, a few months back, given the current Middle East crisis, it is still absolutely there. It's a theme in the background. It's part of the reason why some of the software companies are still in the penalty box. Mm-hmm. And while we think that there's still a lot of legs left, but our ways of playing it is, again, the picks and shovels.
Now, is Tokyo Electron, would it be a competitor with NVIDIA or?
No, so they'd actually likely be a supplier to NVIDIA.
Supplier to, okay. So who would be some of the competition for them?
So there's other sort of semiconductor manufacturing companies that exist out there. I couldn't name all of them off the top of my head, but there are many of them out there that I think you could consider playing. But this is one of the ones that we've historically liked. And again, it also gives us an increase in geographical diversification by getting some exposure to Japan as well.
To Japan. And and with the AI, it looks like it's back on again, isn't it?
So the risk on, risk off.
There had been talk about it, end of the year last year, it was like, show me, show me, show me. And apparently, they're showing, but they're still spending. Their capex is way up, but they're making money, and people seem happy with the AI companies right now.
Well, they absolutely are, and it's not over yet, so it may not be making the front headlines as of right now, but it's still a theme in the background. I don't know one company that's not considering what is their AI strategy on a go-forward basis. So it is one that we're watching very closely. We're happy to participate, but I still think that the obvious winners and losers in the space is hard to determine right now. So this is why we like the picks and shovels method. Yeah,
picks and shovels always seems. The ones who, the gold mine, all the gold rushes, right? The people got rich, the guys who own the store with the picks and shovels in it. What are you telling your clients? Because it has been a rocky time. I mean, but the markets are now back up. What are you telling them? How do you keep them going? Just everything's going to be okay. Or is that what you say?
Well, to a degree, yes. I mean, I think this is where we're seeing a decoupling happening right now of what sort of the rhetoric that you're seeing out there right now, and then the resilience, frankly, of the markets. It seems like the markets are pricing in a lot of the volatility that we're seeing right now. So we're reaching new highs, and a lot of the different indices are out there right now. So there's a lot of this sort of concern from investors, like it's double Dutch skipping. When do you jump in? And then from our perspective, you just kind of need to participate. So this is, again, that same old adage, time in the market is more important than trying to time the market.
Yeah. What is it? The market has more to lose than you can spend?
Yes, or it can remain irrational longer than you can remain solvent.
All right, Shiraz. Thank you as always for coming in. Appreciate it.
My pleasure.
Cheers. And that was Shiraz Ahmed, CEO of Sartorial Wealth. Yesterday on Market Call, we were joined by Keith Richards. He is President and Chief Portfolio Manager at Value Trend Wealth Management. He was covering technical analysis. His top picks were Pato, Mosaic, and George Weston. Today on the show, we have Kim Bolton. He is the President and Portfolio Manager of Black Swan Dexteritas. He'll be taking your questions on technology stocks. And we're going to take a quick break. When we come back, the latest on Honda suspending its Canadian EV project. There are reports that Honda is freezing its Canada EV project amid a strategy overhaul. For the latest on this, we're joined by CTV's Rachel Aiello in Ottawa. Rachel, thanks as always for joining us. What do we know about the plant? It's just north of Toronto in a town called Alliston. What's happening with it?
Yeah, good morning, Roger. So what we know is largely based off of reporting from a Japanese news outlet indicating that Honda plans to entirely suspend its plans to build that $15 billion EV plant in Ontario. Now, this comes after Honda had previously indicated they were going to halt their plans to develop for 2 years, citing market insecurity and stability. So CTV News has reached out to both Canada's industry minister and Honda on this. And what I can tell you, Roger, Honda Canada telling us, quote, has nothing to report at this time. So not confirming, but not denying this reporting. And then similarly along those lines, Industry Minister Melanie Joly did not deny this reporting, telling us essentially, the industry is facing significant change and challenges because of the U.S. tariffs on the sector, and said the Canadian government will continue to support, quote, existing automotive facilities. So read between those lines any way you'd like to, Roger. Canada's finance minister also had this file in the industry file previous to his current job, telling Your Morning today that Canada doesn't have any money directly invested in this plan, but had promised production and building supports for this development, which now seems to be essentially off the table. And I think the big context here is the uncertainty around U.S. tariffs. We had the Japanese ambassador tell our colleague Vashi Kapelos not that long ago that access to the U.S. market was going to be key for any increased Japanese investment in Canadian auto sector. So an indication here that the lingering tariffs from the U.S. is hindering the ability for the Ontario auto sector specifically to develop and get the kind of investment that it's needing.
All right. Something else going on today with the PM going to make an announcement about a different Canadian sector. Any idea what's unfolding there?
Yeah, so we do have some sense. So it might be a less good news day for the Ontario auto sector, may be a pretty good news day for the Quebec aeronautics sector. So the Prime Minister has an announcement later today, this afternoon in Montreal. What his office says is an announcement of a new investment in the Canadian aerospace industry. And now what Reuters is reporting this morning is that that's going to be Airbus announcing that AirAsia is going to be ordering 150 of its A220 jets, which are produced in Mirabel, Quebec. So if that is the case, the Prime Minister will be there to announce this boost for the aerospace sector, but will likely also, Roger, face some questions about the bad news for the Canadian auto sector in Ontario with this Honda plant.
All right. And do we know how long that deal is going to last? Like, is it over a decade or longer?
Still waiting to get some more details on that, but I think at this point it's fair to say any new investment in whatever Canadian sector is going to be embraced and championed by the federal government. Obviously good news for that sector if it is the case. While I think some increasing pressure for the government, we heard this from the Prime Minister this morning indicating there is still a need to get a deal with the United States that works for Canada, because the longer this trade uncertainty persists, it's bad news for the economy across the board.
Yeah, it stalls a lot of things. Okay, Rachel, thank you very much for that update.
Thanks for having me.
Rachel Aiello from CTV News. Coming up, we'll take a look at the stocks moving on Bay and Wall Street. So let's see how the markets are doing or have done. The major Asian markets are finished for the day, but you can see they had the rally on the news out of the Middle East. The Nikkei up at 0.38%. It's well into record territory again. The Hang Seng up by 1.22, and the CSI 300, a similar situation for it. It was up almost 1.5% for the day. And when you go to Europe, look at what is unfolding there. It is on fire today. And again, most of that reaction to the news about what hopefully is unfolding in the Middle East between the U.S. and Iran. There's apparently a one-page peace deal that's being reviewed by the Iranians, maybe a couple of days before they respond. But people are optimistic that this could mean the Strait of Hormuz will be reopening very, very soon. And the European countries were getting desperate for oil. Their concern was that they might be running out, especially things like jet fuel. And so right now the markets are responding to that news as positive. And the FTSE's up 2.2%. The CAC 40 nearly 3%. And DAX in Germany is up more than 2%. And heading down south of the border, no surprise, it's all in the green there as well. Dow Jones up by 0.98, the S&P 500 by 0.83, and the NASDAQ, look at that, it is up by 1.1. One of the leaders there is AMD. It is rallying quite nicely right now. When you take a look at it, in fact, it's up, look at that, it's up nearly 20% on the news that a flood of data center spending has bolstered its sales forecast. It's giving robust predictions for its longer-term growth, sending the shares up, and it could hit a record high if this all continues. And that outlook is upbeat because of some big spending orders from its biggest customers, including people who are looking for alternatives to NVIDIA. So right now, AMD is looking pretty good. And here in Toronto, let's see what's happening right now. The TSX, it is up as well today after that little drawdown yesterday from Shopify. We're going to talk about Shopify in just a second, but you can see the TSX is up almost 1.2%. Look at that. Over the last year, 36%. Let's take a look at how the sectors are doing today. And the big movers going one way, energy again, it's off by 1.66, but materials is up by 0.59, and financials as well up by 1.15. And the one we want to talk about, Shopify quickly. We can take a look at that, see how it's doing after that hit yesterday. It was off significantly, but today it's bouncing back a little bit, not a ton, but it's bouncing back a little bit. Of course, the concern was an outlook that points to slowing revenue growth. And I think we're going to bring in one more here, a top gainer in Toronto, SSR Mining. And it is up almost 20%. I'm just looking at that. Let's see what it's doing here. A reason for that one. See if we can find if there's any real quick reason before we go. Target's got its price target raised to 44 at UBS. And its first quarter results are coming in. So we'll leave it at that there. Join us today at 3 p.m. Eastern for Know Your Options with Chris Tom of Moat Financial. Send in your options trading questions now to Know Your Options at bnnbloomberg.ca. Coming up, could high energy prices break the momentum of tech stocks? That's next with Lindsay Vizcaya.
Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. There are multiple reports that Iran may be nearing a potential agreement with the U.S. to end the conflict. Both sides are working toward a short one-page memorandum with negotiations appearing to gain momentum after a pause in U.S. military activity in the region. Officials expect a response from Iran on key issues within the next couple of days, though neither the White House nor the State Department has publicly confirmed those details. Loblaw's first quarter results came in slightly ahead of expectations, supported by steady performance across its grocery and pharmacy businesses. The retailer saw modest growth in both food and drugstore sales, helping to lift overall revenue. The company is maintaining its outlook for the year and continues to expect solid earnings growth. And shares of Advanced Micro Devices are soaring today. First quarter results for the chipmaker beat expectations as the company issued a stronger than expected outlook driven by surging demand for artificial intelligence chips. Revenue and profit both climbed significantly from a year ago, with AMD's data center business emerging as the key growth engine. And we're going to keep watching the TSX this morning. It's obviously up by more than a full percentage point to start this Wednesday morning. U.S. markets seeing a similar story, mostly in the green today. Tech companies are leading a bit of a stock rally that we're seeing today. The Nasdaq up by more than a percentage point, and same with the Dow Jones. Markets are back near record highs this morning, as you just saw, on optimism that the U.S. and Iran are approaching a peace deal. Our next guest says that while markets are treating geopolitics as background noise, energy is one variable that could break the AI narrative. Here to give his perspective is Jay Bala, CEO, Senior Portfolio Manager at AIP Asset Management. It's great to have you join us. Thanks so much.
Oh, no problem. Thanks for having me on.
So you say that high energy prices could be what breaks that kind of AI tech momentum that we're seeing right now. Why is that?
Yeah, I mean, look, one of the key ingredients for compute and for the AI rally really is just energy. It's whoever has cheaper energy and can build out more compute is going to win the AI rally. And so, if you have oil prices at 100 or or going higher, it makes it more and more expensive to develop all of that AI infrastructure. So I think that's going to be key.
We know tech companies, they've been posting strong earnings so far, but a lot of the results that we're seeing now are from before the war in the Middle East really began. So what are you expecting to see in the next quarter with that in mind?
I think, you might see some prices increase, but I don't think a short-term disruption in energy is going to cause that problem. I think if you have a longer-term issue where, the issues with Iran and the Strait of Hormuz go on for, quarter after quarter, year after year, I think you're going to see some significant problems. But I don't think a short-term problem is going to really slow down anything at this point.
Right, but it is kind of a situation where, like, as you say, if this war was to be prolonged, the longer it goes on, the longer we'd see the after effects, right? The trickle-down effect.
We would. The one thing to keep in mind, though, is, keep in mind that if you look at, Canada and U.S. as sort of one continent, we are energy independent. So, it might not be so great for the rest of the world, but you could effectively create Fortress North America where you have, one energy powerhouse, and we would have sufficient energy to effectively power our AI, and we would have sufficient energy to power our economies. It may not be so great for the rest of the world, but I think we would do pretty good. So there's also that angle that we should take a look at as well.
Do you think anyone is taking a look at that? Because that's a good point that you make, but do you think there's conversations about that being had? Are we really stepping up to the plate in that sense?
I think so. Ultimately, I don't know if it's front and center in terms of news, but I'm sure there's plenty of people who see the realities, right? America is the largest oil producers in the world. I think Canada's number 4, but we are their single largest supply of oil. If Canada stopped supplying everybody else and only focused on our continent, we would do great. I think there's probably a lot of discussions going on behind the scenes where people talk about, building out infrastructure and building out pipelines and making sure that we're at least fortified because, AI is a very important strategic technology for us on a go-forward basis. This will redefine, I guess, human history over the next 100 years. And so, look, we need to get this right.
Okay, so let's talk about some of these big companies because we've got some IPOs coming up, some potential IPOs for SpaceX, OpenAI, Anthropic. You say the Mag 7 could eventually turn into the Mag 10 instead, tell us more about that theory and why you think that's the case.
Yeah, if you look at the sheer size of these companies, they are already, call them top 25 companies in the world. But what's most important is they are the fastest growing companies in the world, right? So, SpaceX, they're talking about coming out at a valuation of $1.75 to $2 trillion in value in market cap. That would make them a top 10 stock in the world.
How would that change the market going forward if there was more Mag 7s, if they became a Mag 10, for example?
Yeah, no, look, I think we just adapt to that new world, but I think this is the new realities, right? You're going to have this huge bifurcation between these monster-sized AI companies that are part of this new revolution, and you're going to have everybody else in a way. The way we always compare it to, AI to history is, it's kind of like building the first new factory, right? Like we're creating the industrial revolution, but more oriented towards services. So, you can imagine 200 years ago or 100 years ago, Ford coming out with a assembly line suddenly changes the entire dynamic in how that industry operates, right?
The S&P 500, we're tracking this week as well, considering changing profitability and inclusion rules for mega cap IPOs. What do you think about this potential decision coming and whether it's a good idea?
Yeah, no, look, I think it's a great idea. I think at the end of the day, we also just need to understand that the world that simply is, meaning that these indexes have decided to compete for the likes of OpenAI, Anthropic, and SpaceX. And so they're effectively changing the rules to make sure that they can compete for these companies because they don't want to get left out. And so, I think that also changes that power dynamic, and it changes the way that people should think about trading these stocks. So the one way we always look at it is that there's an effective index arbitrage here, right? Those that can get in, companies like SpaceX, OpenAI, and Anthropic before the index inclusion are going to stand to benefit. So there's a couple of ways to do that. You can either buy it in the pre-IPO world if you're accredited and you have access to it. You can buy it on the first few days of trading, and then once it hits that index, what you'll see is a huge amount of passive money that rolls into that. Mm-hmm. So as an example, the the NASDAQ 100 has $5 trillion worth of ETF money that tracks it on a passive basis. And that $5 trillion can only buy those 100 companies. And so if you think about, just basic metrics, if SpaceX goes public and it's 1% of the index, that means, as soon as they get added to the index 15 days later, there's $5 billion worth of forced buying power or passive money that has to buy that stock, right? And so you can imagine what happens to that stock after 15 days.
Mm-hmm. For sure. Okay, we'll have to leave it there. But Jay Ballas, CEO, Senior Portfolio Manager at AIP Asset Management, appreciate your time. Thanks for coming on.
Thank you so much.
Coming up, Suncor shares are sinking today despite the oil giant reporting higher profits in the latest quarter as the company produced more oil. We'll get an analyst reaction from BMO Capital Markets' Randy Ollenberger next. Suncor reported record-breaking first quarter production and refining driven by higher output across its oil sands operations. But despite those volumes, earnings still came in just shy of expectations as rising costs and slightly higher debt weighed on results. For more, we sat down with Randy Ollenberger, Managing Director of Oil and Gas Equity Research at BMO Capital Markets.
This one a little bit more modest, as you said. They did have some production outages at the Syncrude plant in the first quarter, and that really did weigh on results. Now, that was anticipated by the street, but even factoring that in, they were still able to beat estimates by about 10 cents. Also important to note that estimates actually went up by about 35% in the month of April. So, relative to where the quarter ended, expectations increased, and they still beat those increased expectations.
Steve, you want to jump in?
Yeah, thanks much. Just a quick question, just regarding the record-breaking production and refinery numbers, phenomenal. How sustainable is that into the future with discussions about increasing production? But what's your look forward going forward?
So, Suncor has done a fabulous job with their downstream assets. They've increased the capacity of the underlying assets by about 10%. And so what we're seeing is much stronger downstream performance out of the company on a sustained basis. They're on track this year to deliver downstream results probably close to $8 billion. That would eclipse the $6 billion in change that we saw in 2022. So the downstream here should be really strong for the company as a consequence both of the improvements they've made in the downstream, but also the macro backdrop. And we're expecting product margins to remain strong right through the second quarter as a result of the Iran war. Even if things were, settled down today, we would still see lingering impacts that would result in elevated margins right through the balance of the second quarter. So a great year for Suncor in the downstream.
And then from the refining side, that cut, what happens there?
So, again, on the downstream side of things, they'll do well. On the upstream side of things, their cost structure is very low. So Suncor has done a very good job at reducing their break-even price by $10 a barrel. It takes now about a $42 WTI price in order for them to cover off their sustaining capital and dividend. That's among the lowest in North America. So they're really well positioned relative to the rest of the sector, but obviously also relative to any drop in oil prices here. We're not clearly anticipating oil prices to drop down to those sorts of levels.
And so 42 a barrel, what have they done to get to that?
So a lot of cost reductions, but staff reductions, operating improvements, those types of things. But the biggest factor really has been improved reliability of their assets. So getting more volumes through what is essentially a fixed cost business, that has really been the big turn for the company. And it's just that reliability, and driving down those unit operating costs has really been the big factor resulting in that drop in that break-even price.
And is there more room there, or is that pretty much bottom of the barrel, so to speak?
No, they're targeting another $5 reduction in that break-even price over the next couple of years here. They just held their investor day at the end of March, and they laid out their plan to deliver another $5. That would put them basically as the lowest within North America in terms of break-even price. So, the company has made great strides, and they're expected to continue to make some solid progress over the next 2 years.
Steve?
Quick comment on the buybacks. Pretty impressive buybacks increased, and looks so for me that's one of the biggest positives. But as well, with the potential for growth here, do you foresee a shift of buybacks to perhaps more capex?
No, not really. So Suncor is targeting to maintain a capital spending program of around $6 billion a year, and they believe they can accommodate about 100,000 barrels a day of production growth, as well as offset the anticipated decline in their base mine in the 2030s. So we're not anticipating any increase in capital spending from the company. We're expecting them to maintain that $6 billion capital program. Keeping in mind what that means is about $3.5 billion goes into sustaining capital, so keeping the business running and maintaining production flat. And then, the additional capital over and above that, $2.5 billion is really what goes into that growth bucket.
And what's the focus next then? What are they looking forward? What are they hoping to accomplish over the next quarter and the end of 2026?
Yeah, so the company is really continuing to lean into buybacks, as you said. But the big change here was really this 100,000 barrel a day growth project. So really what the company's done is laid out all of the opportunities they have on their in situ oil sands asset base that they believe can more than offset the decline in the base mine. So we're talking about offsetting 200 to 300,000 barrels a day of production out of the base mine, and then growing another 100,000 barrels a day on top of that. So that's where the company's focus is shifting to, and that will be their focus over the next, probably 8 to 10 years as they bring that production on.
That was Randy Ollenberger, Managing Director of Oil and Gas Equity Research at BMO Capital Markets. HB Pinterest. Coming up, we'll hear how Pinterest's investment in AI-powered personalization is powering growth for the social media company, which has more than 631 million active users. That's next. Stay with us. Pinterest first quarter sales topped analyst estimates as the platform leaned into the use of its own custom AI models to drive down costs and increase user engagement. Earlier, we spoke with Pinterest CEO Bill Ruddy in a Bloomberg interview, and he explained how the company's investment in custom AI is paying off.
We're really encouraged by the growth on the platform. It's 11 straight quarters of record high users, 10 straight quarters of double-digit growth in users. And at the core of that is that we've really turned Pinterest into an AI-powered shopping assistant that is really, really winning with users, especially Gen Z. That's now more than half our platform and our fastest-growing demographic. Pinterest is where Gen Z goes to shop, and that's been really great for users, and increasingly advertisers are leaning into that, and you see that reflected in our results.
So ad targeting improves, we can see more efficiency, but look, you're getting 80 billion monthly searches. As you say, record high of users. What is the AI strategy here longer term? Because already you're seeing the efficiency in a flywheel.
That's right. So we've shared that we have more than 80 billion searches per month on the platform, which would have been unbelievable to say even a few years ago. And we've done that by really making it a visual-first platform. So much of shopping is a visual journey, and so we are really focused on that. And I think in the world of AI, you've had a lot of discussion around general-purpose winners, but you're also seeing specialization play out, and you're seeing that play out in sort of consumer versus enterprise. But even within consumer, there are a lot of different use cases, and we've been really focused on shopping and visual search and discovery, and we're using AI to power that, really based off the curation signal on our platform, and we're seeing that really, really resonate with users. And of those 80 billion searches per month, more than half of them are commercial, which is a much more significant skew towards commerciality than most chatbots would have, and that you would see in sort of historical general-purpose search. So it really has become a great shopping destination for our users.
It's interesting. Those chatbots had been sort of some of the investor anxiety that this is where competition is coming from in visual search. It is Google, it is OpenAI and the others, but how dependent are you on other frenemies, shall we say, for the large language models? You're training your own, but how much are you using underlying models of others?
That's right. So we primarily run our own compact fit-for-purpose models. I think this is one of the things that you will see over time is there's been so much discussion around AGI and general-purpose models, but they can be really expensive to run. And we've demonstrated that through our own compact fit-for-purpose models, as well as leveraging open source and retraining that off of our unique data set, that we're able to see comparable or better results at oftentimes less than 10% of the cost. And in terms of shopping, we've shared that we're able to get to 30% better relevancy of recommendations on shopping for our users than what we'd see from leading off-the-shelf proprietary models, which just really gets to the uniqueness of Pinterest as a shopping destination. And it's important to note that what makes our models so powerful, it's not just the models themselves. The AI doesn't have taste or style. Humans have taste and style. And so people come to Pinterest to figure out their taste, to figure out how they want to put outfits together. And we're able to learn from that and make better and better recommendations that are aligned to a user's taste. And the result of that is users say things like, well, Pinterest just gets me. And that's something that we think we're doing really uniquely here at Pinterest, and where we just have totally different signal based on what our users do on the platform. And that's what lets us take much smaller but really fit for purpose models and deliver better results for users.
It's not just signal on your platform, though. You've been doing M&A. Talk to us about TV Scientific and why you're going into performance-driven sort of TV ads.
Yes, so we now objectively at 630 million plus users, and 80 billion searches a month, more than half of them being commercial, have one of the highest commercial intent platforms anywhere in the world. And so far, we've been making that a really great platform for advertisers to connect with users here on Pinterest. But we're also looking at how we can make it so that we can help those advertisers meet those users in other places. Connected TV being one of the fastest growing areas of ad demand. It's projected to surpass linear TV in 2028, and we're able to help advertisers show more relevant ads that deliver better returns for advertisers on TV, and users get to see things that are actually helpful and useful to them. And we showed on this most recent call that when we add Pinterest audience data to TV Scientific's capabilities, the company that we acquired in Q1, we see a 65% improvement in the purchases that result from the ads that are shown, which is great for advertisers, but also just means as a user, when you're watching connected TV, you actually see more things. You say, oh, that's actually a product that would be useful for me. And so it's a great thing for users too.
It's interesting. It feels like diversification briefly, Bill, but there's also this moment of Gen Z and teen bands. How do you see that as your role in social media right now, briefly?
Yes, and so we've talked about this before, and I've been very outspoken on this publicly. When I came into Pinterest as CEO nearly 4 years ago, I wanted to prove that there was a more positive business model possible in social media. And so youth online safety has been very out in front for us. We made Pinterest private only for users under 16 approximately 3 years ago. We're the first and still the only platform to do that. Yeah. And so I have publicly advocated for the fact that social media as currently configured is not safe for users under 16. So we turned off social features 3 years ago, and we actually think it's quite an encouraging thing to see regulators around the world starting to really pay attention to that.
Coming up, we'll have your latest headlines and markets, and then we'll take a look at some of the different pricing models that retailers are looking at that sometimes have some big fluctuations. That's next. Stay with us. There are multiple reports Iran may be nearing a potential agreement with the U.S. to end the conflict. Both sides are working toward a short one-page memorandum, with negotiations appearing to gain momentum after a pause in U.S. military activity in the region. Officials expect a response from Iran on key issues within the next couple of days, though neither the White House nor the State Department has publicly confirmed the details. Suncor Energy's first quarter profit missed estimates. However, the company did post quarterly sales of more than $10 billion, which beat estimates. Suncor achieved record Q1 upstream production of more than 875,000 barrels a day. The Calgary-based company said it also had record refining throughput and refined product sales during that period. And Restaurant Brands International's same-store sales growth for the quarter came in slightly ahead of expectations, helped by continued strength at its Burger King chain. The company benefited from steady demand as fast food operators lean into value offerings to attract consumers. The results follow a similar trend across the industry. And we're keeping a close eye on the TSX today to see if it will see more gains. It's up by 1.2% at the moment, still just below that 34,000 point mark. U.S. markets also in the green this morning. Tech companies are kind of leading the stock rally today. The Nasdaq up by more than a full percentage point. Same with the Dow Jones. The S&P 500 just below a percentage point. We're also tracking the price of oil and gas on the reverse side plunging today on reports that the U.S. and Iran are nearing a deal to potentially end the war. WTI down by almost 7% at the moment. Gold, meanwhile, and silver are surging also as a result of that news coming out of the Middle East that there could potentially be an end to this conflict. You can see gold up by more than 3% at the moment. And we're also watching the loonie, which is steadying today amid the talk of a ceasefire holding in the Middle East. Have you ever wondered how retailers decide the prices they're going to charge and how often those prices fluctuate? Well, you aren't alone. NCTV's Pat Foran takes a look at different price models that retailers are using to make some customers pay more than others.
Whether you're looking for a coffee pot or big-ticket purchases like appliances and mattresses, prices will fluctuate. There's been a lot of discussion about dynamic pricing, changing prices based on demand, but retail analyst Bruce Winder says that's not new.
If you get your weekly flyers, you'll see prices go down for a week and then they'll go back up. And then maybe 6 weeks later, they go down again.
Consumer Reports just tracked 16 popular products to give shoppers a clear picture of how prices rise, fall, and fluctuate. Take this Shark vacuum.
1 week it was like $119, and at its peak it was close to $200. So it would swing by $40 or $50 a week. We're seeing it with baby products, a lot of clothing and footwear.
While some retailers are experimenting with surveillance pricing in the U.S., where consumers are charged different prices based on their personal data, Winder feels it won't be prevalent in Canada.
Charging consumers different prices because they're different consumers is taboo. The reputational damage to the company would far eclipse any margin gain.
If you're trying to save money on electronics, consider buying an older model. TVs, phones, and laptops that are a year or two old can cost hundreds less. And consider refurbished products.
They take it, they clean it up, they replace parts, and you get it with a new 1-year warranty. I mean, there's no better deal in my mind than getting a refurbished item.
Certain items also go on sale at specific times of the year. AI can help research that. If you can hold off on a purchase, you could save money.
And you might find out that this is one of the items that is really used aggressively on Black Friday or Cyber Monday or Boxing Day, right? And if you can, you might wait.
Oil is down as stocks gain on hopes for an end to the war in Iran. Earlier, we got perspective on what this means for the oil markets with Stephen Shork, principal and editor at The Short Group. Take a listen.
I suppose it's progress, but we really do have to take it into with a grain of salt. Keeping in mind that the futures market can reprice instantly. They can reprice as fast as a trader can hit the sell button on their keyboard. So to paraphrase Ronald Reagan, futures markets trade on trust. The physical market trades on verification. So yes, we do have this headline, but the physical market has to see more than just a social media post. So vessels that have been diverted away from the Persian Gulf are going to remain diverted. Refiners who are now buying because we're entering the peak season, buying crude oil, are going to continue to buy at high prices. So we are looking at higher prices longer, regardless of what we're seeing in the futures market now. So the point being here now is that, yes, this is potentially good news, but hey, we've been down this road before. We've seen these spikes both up and down in the future markets before, but what we're seeing in the physical market, what you're seeing in the spreads, whether it's Dubai, Brent WTI, Brent versus Houston, the physical market has an extreme pull on the market, and prices are going to remain higher, certainly as we kick off the summer driving season.
Thank you for that dose of reality, Stephen. When it comes to the inventories globally, where are we? How tight is this market?
Yeah, it's not, well, it's really interesting. So it's not necessarily about barrels per se or supply. It's about logistics. So regardless of how much supply, and for instance, here in the United States, we are at multi-year highs when it comes to crude oil. And this is what's happening. The vessels are coming to, as the president in your clip before said, people are learning to buy U.S. oil. This is true. So what happens? Empty vessels are leaving lower inventory markets to come to the United States to load up, which leads onto a lag time of longer transit times, which will keep the market short of oil. So not necessarily because of the supply, but it's because of the vessel economics or the lack of vessels. And this is where the market has dodged a bullet up until this point. That is to say, this conflict began back in late February, early March, when demand for crude oil is at its weakest. Then we went through March, April, when refineries are in their turnaround season, their maintenance season. They are buying fewer barrels of oil, getting ready for the summer. Well, guess what? The summer is here, or it's about to be here. Refiners are coming out of their maintenance season. They have to buy these barrels, and therefore that is keeping the bid in the market. And that is most likely kind of the impetus of the White House to push this narrative that a peace deal is almost afoot, because the hammer is about to hit the market. The demand, the one variable that's been missing from the market, has now returned, and it's going to return with a vengeance in the weeks ahead.
Also, it comes, as Jonathan has been saying, U.S. gasoline is above $4.50 a gallon, the highest we've seen since 2022. Could we get to $5 in the next few weeks?
Not likely. So what we've seen here, and the Federal Reserve has a study that's called Rockets and Feathers when it comes to retail gasoline prices. When we see a disruption in the flow of oil, prices at the pump will take off like a rocket. But then when we see some sort of resolution to whatever disruption it is, prices fall back to earth like a feather. So there will be a lag. Now, retail gasoline prices on average, where you're looking at the EIA or AAA, are about $4.55. On a national average. They're going to remain there for the next few weeks. Can we get to $5? At this point, I do think it is unlikely, given where wholesale gasoline prices are trading in the United States. So if we are not at the peak of retail gasoline prices currently, we are going to near that price, or we're going to near that level within the next few weeks. But that's not to say we're going to see a continued pullback, because keep in mind, in 3 weeks, 4 weeks, it's the Memorial Day holiday. So now prices will begin to remain high. So that feather aspect will remain high. Prospects of $5 gasoline, looking at 10 years worth of regression, is very limited proposal at this point.
Coming up next is Hot Picks. We will zero in on 3 covered call options when we come back. Stay with us. Welcome back. It's time now for Hot Picks, and today we are looking at 3 covered calls, an option strategy where investors sell a call option on a stock they already own to generate premium income. Our next guest says Micron is a great stock for this option, so here to tell us more is Jonathan Mulchin, Senior Portfolio Manager and Head of ETF Trading at Shelton Capital Management. It's great to have you join us. Thanks so much.
Thanks. Thank you for having me.
I just gave the briefest description of what a covered call is. So I think before we get into your picks, can you just explain to our viewers a little more about what a covered call actually is?
So yeah, I mean, a covered call is a great mechanism to generate cash flow on favorable thematic investing strategies. When we look at technology for largely the last 10 to 15 years, it has been in favor. The Mag 7 AI has pretty much dominated the headlines of late. And what a covered call will give you the ability to do is to participate in that segment of the market, but to also generate cash flow at the same time. In a time where income-focused investors are really struggling to figure out where to position money.
Okay, so let's get into it then. Your first hot pick, we'll talk about the company first, and then we can talk about why you pick it from a covered call perspective. But Micron Technology, you say tied to the AI infrastructure build out, obviously, in a big way. What is it that you like about Micron, first of all?
Well, if you look at more of the AI theme, everybody's been focused on NVIDIA. If you look at year-to-date performance, Micron has massively outperformed NVIDIA. It's a derivative pick that is loosely correlated to that, but still in the space. When everybody owns the same position, it becomes a little bit riskier. if there is a flight out of that. And I think, a lot has been talked about with the dispersion trade in the last year or two. The implied volatility on Micron relative to the NASDAQ is roughly double. So the cash flow that you can generate even 1 month out writing a covered call is, 3 to 5%. It makes it really interesting to own something that is quality, that is relevant in the market, and that can generate that cash flow.
Okay. We'll move on now to Amazon. That's your next hot pick. You say it gives investors exposure to two major themes at once. So let's talk about those two major themes first of all.
Yeah, I think in the headwinds of everyone talking about recession and inflation, looking at the stock price of Amazon is incredible because it has basically performed lock and step with the NASDAQ 100. The consumer in America is resilient. And then they also have the AWS story. So, now you're broadening out and diversifying your exposure, where you're getting a little bit more of the broader economy, but you still have that AI theme. And no different to Micron, you are also getting supreme cash flow in the marketplace for owning a high quality stock.
And from a covered call perspective, you say the angle is not about avoiding risk. Can you elaborate on that?
So when I look at the covered call space or any overlay space in general where you are trying to generate cash flow using call options, it is a way to supplement income, but it's also a way where you can dampen the kind of performance spectrum that you're going through. Where I'm going with that is you can dampen volatility while generating the cash flow, which makes it a pretty interesting investment option for those that need that yield.
Next up, your pick is Tesla. This is your third hot pick. So tell us about why you picked this company, first of all. It's another kind of pricier stock, right?
Right. So I think the three main pieces here are that Micron is with more of the AI pitch. Amazon will start to delve further into the consumer side of the economy. And then with Tesla, it just goes back to show you how much innovation is within technology right now. To the point where indexes are reconstitutioning their methodology to include SpaceX going forward. It is a very innovative company. And when you look at, again, similar to Micron and Amazon, the yield that you can pick up on a covered call, these are great companies that you can generate extreme cash flow off of. But the themes are in place with the companies where there's a reason to buy the underlying common stock.
And that's also because there's a lot of volatility, is that right? Like, can you explain how significant volatility can also factor into Tesla, for example, as a covered call option?
So the higher the volatility, the more premium you're going to receive when you write a covered call. And so this could be a better way of people owning these positions rather than just outright. And it comes back to that smoother distribution of returns where you don't necessarily have to worry as much as long as you're hitting that income-oriented goal. But you still own high-quality names. At Shelton, we have a handful of 40 Act products through mutual funds and active ETFs. And, we also package these for investors so that if they don't necessarily feel comfortable doing it, individual stocks or on their own, that they can turn to us and kind of lean on our expertise in the option space.
Right, because in that space, like for someone who's just getting into trading with covered calls with options, like what's some of the first things someone should look for if you're new to this? You
should always trade what you know. And, from a risk profile, a covered call is a great way to engage in certain stocks that have higher volatility if you are an income-focused investor. I think, as people look at where technology and these growth stocks have gone, that a covered call approach right now is a great way to still be involved in the market. And you're basically solving for two problems at the same time, which is how do you supplement the income component of your portfolio, but how do you also make sure that the principal balance grows?
Okay, we'll have to leave it there. Jonathan Mulchin, Senior Portfolio Manager and Head of ETF Trading at Shelton Capital Management. Appreciate your time. Thanks so much for joining us.
Thank you.
And join us today at 3 p.m. Eastern for Know Your Options with Chris Tom of Moat Financial. You can send in your options trading questions now to knowyouroptions@bnnbloomberg.ca. Coming up, we will hear from EQ Bank's President and CEO Chadwick Westlake on their acquisition of PC Financial from Loblaw. That's after the break. Stay with us. EQ Bank says it has cleared the last regulatory step in its $800 million acquisition of PC Financial from Loblaw, with the Canadian government approving that deal. The transaction was previously cleared by Canada's competition watchdog and is set to close this summer. For more details, we sat down with EQ Bank's President and CEO Chadwick Westlake.
This is a historic pace. This is putting actions to follow all the words and the statements that have been made by the federal government of Canada needing to move faster, act with urgency, think big, really improve our competitive presence in this country. And that has happened. So we are very happy and we applaud and are appreciative of the federal government. And earlier this afternoon at the Canadian Club, I expressed my thanks to the Prime Minister and the Minister of Finance for these actions they've taken. It's the fastest pace in the history of Canada.
You're looking at this closing by the end of summer, at which point you will have a retail front, you'll have deposits, you'll have a credit card business. All of that will be new to you. And I'm wondering where you will focus first.
Well, we're going to focus on getting this deal closed very well and executed. This makes us a more complete challenger bank in this country. You're right. It completes our product shelf. It differentiates us. We're going to focus on making sure the experience is consistent for the PC Financial customers today. We're going to strike this new long-term partnership with Loblaw and ensure consistency. We're going to bring PC Optimum to even more of our products and make sure that we maximize that loyalty program for Canadians. So we're going to focus on getting that done well while serving our existing business on the single-family lending and commercial side as well.
So personal banking will be obviously important to you. I'm wondering how you will challenge the big banks in that space.
Well, we have differentiated products, so no other bank can have this omni-channel setup where we're going to be where customers are, be that online with our digital platform, be it in a Loblaw store where you see our pavilions, and be it anywhere that you use PC Optimum. That's a very important loyalty program for Canadians. That's over 17 million Canadians that leverage that. We will be the exclusive financial services provider of PC Optimum. So we're going to be with where customers are with the tools and the products that they can't get anywhere else.
Was that part of the bigger outlook when you were looking at PC Financial? Is that Optimum program, which so many people have bought into?
Yeah, it's an important part of accelerating our strategy with the products, with cultural alignment with the companies. And I'd say Loblaw and EQB share a very shared sentiment on Canada and ensuring better lives for Canadians, better financial health for Canadians. And with PC Optimum, we can differentiate our products, but get more of those points into people's hands. That pays for groceries, gas, healthcare. It's very important these days when a lot of Canadians are struggling or want to be rewarded for their financial services.
Will you change that structurally at all, or are you just looking to add points to different parts of what you have going?
Yeah, we'll bring it into more of our products, more of our everyday products, maybe mortgage products. It will become part of our ecosystem, where PC Financial will eventually be rebranded simply to EQ Bank, Canada's challenger bank. PC Optimum will stay under the ownership of Loblaws, and we're going to bring the most of that to Canada. And then EQ Bank will show up all over the country. Be at the top of an Esso station, Shoppers Drug Mart. We will be everywhere where Canadians are.
Housing in this country is struggling, obviously. I'm wondering if you are making any changes to the mortgage side of your business.
Yeah, we're a reflection of everyday Canadians. And we did a poll with Angus Reid as well for our customers. What we're finding is 2 out of 3 Canadians are cutting back on non-essentials, and half of Canadians are actually having to dip into their emergency funds. That's concerning. And EQ is a reflection of everyday Canadians. So yes, we're seeing people struggle to afford new housing, to actually get a place to own or rent. And last year, we did about $6 billion in single-family mortgages and about $7 billion in CMHC insured multi-unit. So that's purpose-built, affordable. So if you want to own or rent, we're trying to get people into homes. And we underwrite to every single individual Canadian. Everyone matters, not just abroad based on your credit score. We're going to underwrite and do the work.
If there is an interest rate hike, which some are expecting now, will that challenge what you plan to do now?
No, we lend through the cycle, and we're going to help Canadians no matter what happens. I think an interest rate increase would apply more pressure on Canadians that are struggling. Right? Even the increase in gas prices, that can mean some people need to trade a meal a day. Right? Anything can happen. So yeah, we're very attuned to it, but we're going to lend and work through that with Canadians as rates change.
That was EQ Bank's president and CEO Chadwick Westlake. Okay, we're going to take a look at how the TSX is trading right now, seeing some potential gains, or it is seeing some gains, to start the morning up by more than a full percentage point. Now it's above that 34,000 point area that it's been below for the last couple of days. So we'll keep watching that for you today. We'll also show you some of the top gainers in Toronto. SSR Mining is one of them today, up nearly 20%, just above 17% at the moment. The company saw an upgrade from UBS after reporting better than expected earnings late yesterday. So we'll keep tracking that for you. IM Gold, also a top gainer. Shares are up the most in more than 12 weeks at the moment as profit tops forecast. And you can see IM Gold is up more than 16%. To the downside, though, Vermilion Energy is the biggest loser in Toronto at the moment. It missed profit estimates in the latest quarter, and the company also had an unrealized derivative loss that hurt results. You can see down more than 10% today. We'll keep watching Vermilion Energy for you. U.S. markets, we're watching those closely. Also, all in the green today, all above a full percentage point at the moment. Look at that. Tech companies seem to be leading the stock rally today amid some solid corporate earnings as well. S&P 500, Dow Jones, and the NASDAQ all up by more than a full percentage point. And if we're looking at particular companies in some of these markets, AMD shares are soaring. They're seeing the biggest gain since October today after a flood of data center spending bolstered its sales forecast. It's up more than 15% at the moment. AMD's upbeat outlook signals that it's winning orders from the biggest spenders on artificial intelligence computing, with data center customers increasingly seeking alternatives to NVIDIA. And we're also watching the price of oil today. Oil and gas actually plunging on reports that the U.S. and Iran are nearing a deal to end the war. WTI down more than 7% at the moment after spiking ever since this conflict began earlier this year. On the flip side of that, gold and silver surging today, also as a result of the news that potentially the war in the Middle East could soon be coming to an end. You can see gold up more than 3% at the moment. And we're also watching the loonie, which has steadied as the ceasefire in the Middle East continues to hold. So continuing to watch that for you. Yesterday on Market Call, we were joined by Keith Richards. He is president and chief portfolio manager at Value Trend Wealth Management, and he was covering technical analysis. His top picks were Peyto, George Weston, and today on the show, we've got Kim Bolton. He is the president and portfolio manager of Black Swan Dexteritas, and he'll be taking your questions on technology stocks. Again, that's 12 Eastern time. Be sure to tune in for that. And that wraps up this edition of The Open. Morning Markets is next.